Okay, ladies and gents, welcome to the Financial Juice stream the MACROACE live stream with your host, Tony. I am also the head financial analyst at Financial Juice. So again, thank you very much for joining me live. Let's go through the Bank of Canada, just getting the mic set up and sorted. So let's go through this here. Bank of Canada expected to keep the rates at unchanged. At 4.5%, but there is some expectation that they might decide to deliver with a 25 basis point hike and surprise market like the RBA did Tuesday night. So there's also that expectation that we've got to just bear in mind of what some also economists and some of the investment banks have been repricing for the Bank of Canada as well. And we'll go through, what we'll do is we'll detail what to expect from the release, how it affects the markets, and what is the sentiment surrounding the Bank of Canada as well as the RBA and how that's having an impact on expectations. Okay, so first of all, let's go through how does it affect the market. So with the currency market, what happens is if you do see a rate hike from a central bank, usually that means that the currency will appreciate in value, particularly if you're talking about the short-term reaction in the markets. When if you do raise interest rates that are above expectation, that leads to a stronger currency if it's higher than expected. If you do get a rate cut, then of course the value of the currency goes down because it becomes less valuable, and things become cheaper. And then that usually boosts the stock market instead if you have lower rates of interest. And then if we're talking about the bond market, for the bond market, whenever you raise interest rates, you've got to think about the yield on those bonds. So whenever rates are raised, the yields on the bonds go up and the price of the bonds go down. Again, it's because of, how very connected the bond market is to whatever the interest rate is that is set by the central bank. So again, whenever rates are raised, bond yields tend to go higher, and we've seen that in the past, not just in Canada, but also if you've been living under a rock, we've also seen that in the US as well as other nations too. Particularly even before a rate decision has come out, when there's pricing or when there's other economic releases such as non-farm payrolls or inflation data from the US or even in the UK or the Eurozone markets, you can see and you have seen that bond yields start to creep up higher in anticipation that rates will go higher, and that means the value of the currency starts to go higher as well. Now, if we carry on with where the economy is at the moment, so we know that CPI, or inflation, is at 4.4% compared to 4.3%. Now, we're getting closer towards the central bank's goal of 2% as their inflation target, but we'll talk about the RBA and what that could mean for the Bank of Canada today, how that might affect their decision. But first, let's go through this here. So inflation ticked up by 0.1% from 4.3 to 4.4. GDP quarter-on-quarter annualized rate was at 3.1% compared to the fourth quarter of a flat reading. Employment change, what we had was at 41.4K versus 34.7K. Of course, we've got the Canadian employment change data this Friday to have a look at. Average hourly earnings was unchanged at 5.2%. Unemployment was also unchanged as well. Retail sales for Canada was at minus 1.4% compared to 0.2%. That's for the month-on-month figure there. PPI was at minus 3.5% compared to minus 1.8%. Don't forget, if you're finding this information useful so far, then don't forget to share it with your fellow traders and friends to get in on the information. So, if we look at the raw material price index as well, for Canada, it was at 2.9 compared to minus 1.7. And just to summarize, before I kind of go on, this is what the Bank of Canada, these are the indicators that the Bank of Canada will be looking at to understand what is the economy like overall with prices, with the jobs market, what is consumer spending like, is it strong, is it weak? Those are the kind of factors that they take into consideration before making their decision on the rates, on the rate and where it should be, and what they should say in the monetary policy statement, of course, which we're going to be getting out today as well, alongside the rate decision. So this is why it's always important to look at where the economy is at the moment. Then you have the previous Bank of Canada rate decision. So what do we already know so far, and and then it's a matter of looking at the current or the new statement, comparing that to what the previous statement was. So back on April 12th, annualized GDP, they said in Q4 2022, they saw it at flat compared to 1.3% in January, 2.3% in Q1 of 2023 versus 0.5% and 1% in Q2 for 2023. So already for the first quarter in Canada, we've seen stronger than expected GDP data compared to the Bank of Canada's expectation of 2.3%. If we came out at 3%, that's much better than expected. Then they also said that they expect inflation to fall quickly to around 3% in mid this year, and then decline more gradually to 2% target by the end of 2024. The Governing Council continues to assess whether monetary policy is sufficiently restrictive and remains prepared to raise rates if required. And then if we look at the meeting minutes, this, of course, this is quite new to the Bank of Canada to provide meeting minutes of what's going on, as requested by the IMF for them to do, to get a better understanding of where their monetary policy is and what's the current sentiment, what's the current feeling surrounding the Bank of Canada and their board members. So market expectations at the time for a rate cut later in 2023 didn't seem to be the most likely scenario. Governing Council agreed that it was important to continue to signal that it was prepared to increase its policy rate further if needed. And if we move on here to the Bank of Canada review, May 18th, they said the overall Canadian banking system remains robust and market participants continue to express confidence in the Canadian financial system, including the banking sector. And if a market-wide liquidity crunch were to occur, the bank could provide liquidity to Canadian financial system through various facilities. So if we're talking about what the path looks like then for the Bank of Canada and what they've already done, we know in the past, like with the Fed, they have surprised us with bigger than expected rate hikes. When they were expected to do a 75, they did a 100 base point hike in the past. And with the Federal Reserve, when they're expected to go with a 50, but they went with a 75 instead. Again, that was off of the inflation data. What we've got to understand is that the Bank of Canada isn't crystal clear. There isn't a crystal clear path with them, i.e., they go through their hiking cycle and then they stop and then that's it, and then they start to cut rates at some point. You'll get, from what we've seen, what we've seen with the RBA, where the RBA were hiking rates. They paused at one meeting at the rate of 3.6%. And then at the following meeting, they decided to take a 25 base point hike to 3.85%, and then another one to 4.1% because of the overall issue that they have with inflation in Australia at 7% on the yearly, on the year-on-year figure that's released quarterly. So that's the reason why the RBA took that step, which was much more hawkish than markets were expecting. And this is where we start to get other pricing in, if we kind of go through this. So this is where we start to get pricing in coming in of, instead of the Bank of Canada holding rates where they are, that maybe they might follow suit with what the RBA has done this week as well and decide to surprise the markets with a 25 base point hike. So if we're looking at TD and what they've said in the past, back on April 27th, they say that they continue to look for the bank to hold rates at 4.5% into 2024, but today's minutes should reinforce that risks are skewed towards more hikes in the near term. So they were initially expecting the Bank of Canada to hold at 4.5%, but since the RBA rate decision has come out and surprising the markets and economists and going ahead with a 25 base point hike rather than staying on hold, they're now looking for a 25 base point hike. So why has that happened? It's because of, well, of course, these central banks, they're interconnected quite a bit. So if one central bank decides to raise rates by a mega amount, more or less other central banks will follow suit. And we've seen that during the beginning of the hiking cycle, when you've seen the Bank of Canada raising by bigger amounts and the RBNZ. Then you've seen the US start to raise by bigger amounts because of the overall issue of inflation at that time, and still it remains to be an issue for the RBA. The other thing is they don't want to, if one central bank is pausing rates and other central banks are raising rates, that means the currency of the country that's pausing rates becomes less valued compared to, or less valuable compared to, the other currencies in the short term. Even though they may have a higher rate of interest, you could still see a push to other currencies where the central bank may be continuing to tighten their monetary policy, because there is the expectation that they're not done and they could go higher than what the other central bank may have done where they had paused. So there's also those factors to take into consideration as well. If we look at what CIBC said when they were referring to monthly GDP, which was at 0.1% compared to 0.5% on April 28th, they said that while a weakening economy should prevent policymakers pulling the trigger on another interest rate hike, we don't see cuts forthcoming until early next year. Now, of course, that could also, CIBC haven't changed their rhetoric in regards to expectations of looking for a 25 base point hike instead of the central bank to remain on hold. But it's still, if we went back to where the economy is at the moment, if inflation is near the target, if inflation is near the target of what the Bank of Canada, wants it to be, do they need to go with another 25 base point hike? And then further down the line, that damages the economy more than they would have wanted it to do, just to kind of stay in tow with what the RBA has done. There's also that thought there to consider too. June 2nd, as you had 18 of 28 economists saying that the Bank of Canada is going to keep the rate steady at 4.5%. But there's also, according to 11 or 15 economists, they said that the high risk the bank will raise the key rate once more. So again, this is why the expectations for some of the investment banks, like TD, have changed and have gone down the route of saying, okay, maybe the Bank of Canada is going to go with one more hike instead. So if we carry on then, so what we also have, we also had swap traders that are mostly betting that rates will stay on hold. So again, bear in mind, this is June 2nd, before we had the RBA rate decision on the Tuesday night, Eastern time, if that's what you, or Tuesday night, Tuesday morning, if you're in Eastern time at 12:30 a.m. Eastern time. June 6th, then this is where things change, okay? So Citi, JP Morgan, Scotiabank, and TD expect a 25 base point hike today from the Bank of Canada. Scotiabank, again, as said, what we were talking about, we were talking about the RBA earlier on. Scotiabank citing the RBA surprise 25 base point hike as a change to the outlook. So what they're seeing is that if there are central banks that are still have a need to raise rates or interest rates, then that could also mean other central banks might follow in tow, so as to not let their currency lose value compared to the other currency. But again, if there is a strong coordination between these central banks as to how far they go with the interest rates, or let me say if there isn't, then the Bank of Canada may decide to say, okay, we'll just stand pat. And we know inflation is going down, and that should do it. But like you said, if we did see 4.4% compared to 4.3% inflation for the year-on-year inflation in Canada, is that enough for the Bank of Canada to say, okay, maybe we need to switch our thoughts around, maybe we need to do one more hike just to make sure we don't see another jump in the inflation figure. Again, that's another reason that the Bank of Canada could take a 25 basis point hike, 25 basis point hike instead of standing pat and standing on taking a hold decision instead. Goldman Sachs also cites labor market has increased the chance of another hike this year, but that will most likely happen in July. So if the labor market has been strong, but they have seen inflation go down, and inflation isn't as high as it is in Australia, of course, bearing in mind there are other factors that Canada has to deal with compared to Australia, although they're both commodity-based nations, then that shouldn't have an effect on what the Bank of Canada does today. But later on, further down the line, if the jobs market does decide to heat up again, then continuously, not just for one report, then the Bank of Canada might just have to take one more step to make sure that more jobs being taken up don't lead to more spending in the future. So I wanted to kind of go back to, I did kind of skip out some of the Bank of Canada views, but there's only a couple here, there's not too much. So you had the Bank of Canada views, what they said that there is a risk that inflation will get stuck materially above the 2% target, and then we've paused, but that doesn't mean that we've reached the end. So that was according to, again, Macklem, and then Macklem also added that we will get back to the 2% inflation target around the end of 2024. But nothing explicitly saying that that's it, we're done now. We can just sit and just see what happens. But saying that we've paused, but that doesn't mean that we've reached the end. There may be the chance for more rate hikes to come through, and this could be the meeting if the RBA has set the precedent from their meeting this time around and their previous meeting for the Bank of Canada to say, okay, those guys are doing it too, we should feel comfortable in doing it ourselves as well. And I think that CPI report coming in 0.1% higher for the year-on-year figure could just be enough to do that. But again, it's all dependent on what we get from the statement as well. If the statement backs a 25 basis point hike, or if we get a dovish hike instead. So let's kind of go through. So let's look at the last release that we had from the Bank of Canada and how the market's reacted. And we'll look at the deviations too. That is what everyone or a lot of people do ask for, the deviations for how the economic releases affect the markets and how big were those movements. But first, let's kind of look at how do the markets react on the initial release of the data. So this is about 10 seconds before the prior release that we had, and so we can see if we'll kind of just wait for the countdown to happen. But you can see I've got my GP CAD, Euro CAD, and USD CAD up and running. Usually in the past, the biggest reaction that we've seen in the past had been generally has been on Euro CAD. What we've seen CAD JPY and GBP CAD. So there you go. The rate comes out. There wasn't. So here's sentiment. Okay. So the sentiment was back then. It was nothing new. It was the same. It was a repeat of before what was said. There wasn't anything exciting for the markets to take in from the rate decision, and the moves were very, very small. So before that, though. Even before that, in the last release, again, whenever you see the central bank repeating what they've said and they keep the rate on hold, you don't see a strong market reaction. You might either get a small whipsaw reaction that occurs, or something like this, where it's kind of just carrying on what it was doing beforehand and not really focusing on the report. Or the monetary the statement itself. So what I'm saying here is that we've got to look out for any sort of surprises from the Bank of Canada. Do they say they need to, they've got to flip the switch, and that's the reason why they went with a 25 basis point hike today, which could give some positive momentum, provide some positive momentum to the Canadian dollar today, if that were to happen. If the majority of economists are looking at no change, but some are now looking at a 25, Of course, it might not completely rocket in the air with a 25 base point hike. You might see a bit of a blip up. It might hold for a little bit and then kind of go back down if the expectation rises or had risen for 25, and if that's what happens today. So again, the market reaction was very minimal. Didn't really do that much. There wasn't anything new from the Bank of Canada. So what we're looking for out is in the statement is, do they say inflation is still a problem and it's worse than they had expected it to be, and there's more work that they need to do, hence they take a 25, or they say they will need to raise rates in the future if they decide not to do it at this meeting today. So if we kind of go, so that was the release. So let's look at the deviations, right? You guys want to know how big the movements were for this economic release. So if I just bring that out here, okay, here we go. So here we are. So this was how big the market reaction was last time. So the deviations, let me just explain it to you if you've not come across it before, if you've heard about it. The deviations show you how strong the market reacted to an economic release. And I show you here in the first, more or less, the first 10 minutes or so what's happened. So this figure here shows you what happened on, if you can see it there, the first minutes, or on the first candle going to the wick of the candle, how big the reaction was. And then this figure shows you here the reaction, or how far the market had moved 10 minutes after the release. Okay, or the asset had moved 10 minutes after the release. So you can see here that, again, the initial reaction was compared to what we've seen in the past, right, where we got to up to maybe 100 pips on GBP CAD, or near enough 100 pips, or basically 100 pips on GBP CAD. Now that kind of things have cooled down and there's nothing new or crazy that's out, or that was put out by the Bank of Canada last time, you get this, you get these small moves that occur. So GBP CAD saw about 9 pips towards the upside initially, and again there wasn't anything surprising from the Bank of Canada, or anything new or hawkish enough for the Canadian dollar to see a bit of strengthening. Rather, it's a little bit of weakening, and then the market's carried on. You can see here, after about 10 minutes of trading, GBP CAD was down 10.5 pips. Okay, but again, as said, nothing new, and it was a repeat of what had been said before. But you can see there, that would probably be, you see that if they're considering taking the need to raise interest rates to combat inflation, that still had strong reaction within the market. And then when they pivoted and said that we're likely to hold rates, then there was a reaction, a decent reaction there, not as big as previously, but there's still a reaction there within the market. But now, again, we look for a pivot in their rhetoric. Okay, that's going to be quite key. So let's just make this clear. If the central bank raises rates by 25 basis points above the expectation, okay, you could see an appreciation from the Canadian dollar. If they decide to hold rates as expected, you could see a bit of weakening if there was the build up of the expectation for a 25, but not that great of an expectation for a 25. Or we could, unless they decide to cut rates. Which would be crazy at this point if they're still talking about the need to combat inflation. If they decide to cut rates, they need to see weakness from the Canadian dollar instead of rather than an appreciation. Of course, that cuts the value. Whenever you decrease rates, that devalues that cuts the value of or attractiveness of your currency. Hence, you get people that jump out of the currency in favor of another currency that's got a high rate of interest. Instead. All right, so we got about 3 minutes. 3 minutes to the rate decision. Again, as said, the forecast is for no change. What we've got to be prepared for is not just the rate itself, but also the statement. Okay, do they talk about inflation as being more problematic than they thought it would be, or do they see a much stronger Canadian economy than they would have previously have thought? And the other thing is do they go with a 25 base point hike, or do they stand pat and say they've kind of done their job and things will go back to normal. So what we'll do is we'll go through the rate statement ourselves, see what was said, what was different, and then kind of make up, and then of course see what could happen further down the line with the Bank of Canada. All right. Okay. Okay, we've got less than 2 minutes. So FinancialJuice is where we'll see the figure coming out on the website. So FinancialJuice, if you don't know what a live voice or text service is, FinancialJuice is there to help you understand what's going on in the markets, basically, and why the market's moving in a certain direction. Has there been macro... Okay, so we got the rate statement, excuse me, rate decision, less than a minute now. And then we get the rate statement. We'll talk about FinancialJuice in a little bit. Okay, let's get TICKSTRIKE up and running as well. And we get it set on our Canadian releases. Okay. Okay, 10 seconds. Hike, 25 base point hike, 25 base point hike to 4.75%, higher than the expected for no change. So again, hike 25 base point hike, higher than the expected for no change. Also seeing, so the Canadian dollar strengthening here off the back of that data. Again, a hike by 25 base point hike, higher than the expected no change. So if we go through the statement as well and see what was also mentioned from the statement. So the Bank of Canada, it remains resolute to its commitment to restoring price stability. Canadian housing activity has picked up and labour market remains tight. Canada's economy was stronger than expected in the first quarter. Again, that's why it's important to understand what's happened before in the economy and what is the Bank of Canada looking at. Consumption growth was surprisingly strong and broad-based. It will continue evaluating whether evolution of excessive demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving inflation target. It continues to expect CPI inflation to ease to around 3% in the summer, but drops reference to inflation gradually falling by the target by the end of 2024. Again, that's quite a strong part of the statement there, that maybe that they've got to fight inflation for longer than they would have anticipated. Okay, although they haven't explicitly said that, they've removed the language of that. Underlying inflation remains stubbornly high globally. Major central banks are signaling that rates might have to rise further to restore price stability. Okay, so this marks the rates at 4.75% being the highest in 22 years. So of course, not only is inflation just the issue, but there's also the labour market is what they cited. They remove April language about how the bank is prepared to raise rates further if needed as well. So there's also that having an impact as well. This is how the rest of the markets are reacting. So US Treasury yields rise off the Bank of Canada raises rates. 10-year yield up 2.6%, 2.6 base points, to at 3.726%. And also the Canadian dollar strengthening by 0.5%. So let's do some measurements. So a hawkish central bank statement there by the Bank of Canada. If we have a further look into it, if we have a further review into what the markets are doing. So don't forget. Sorry, I'm just trying to get my headphones back on. So don't forget, this is again, if you want to have a live voice and text service such as FinancialJuice, then this is the place to do it. So we can see the initial reaction here. Let's see how big the reaction was. It might not go to 50. It might go to 50. Oh wait, it went to 80. Yep, that's let's see. So that's been the biggest reaction that we've seen in or near enough the same reaction. Let me get it back up on here. There we are. Okay. So just off the initial reaction, so GPCAD at 80.5 pips, okay, down. So of course, Canadian dollar strengthening by quite a bit there. The last time, so that beats the movement amount of December 7th, 2022. Back in December, okay, we had a 77 pip move, or 77 pip move down on GPCAD. So this is much bigger than before. I haven't, of course, added the new figures, so you can't see the rest of the other ones. So I've got to go through that later. But you can see there that, it's, as I said, the biggest reaction for GPCAD, and I'm sure it's going to be similar to the other ones too, since December the 7th, 2022. So what does that tell you? That the idea that inflation is still a key point of contention for these central banks. One of them, of course, being that they remove the language of seeing of inflation, or removing the inflation gradually falling to 2% by the end of 2024. So does that mean that, of course, they've got more work to do? Well, with this rate hike, it probably does. It probably could mean that. But again, so strong reactions from the market. EuroCAD, let's see how big that was there. Okay, 60.5 or 66 pips down. Okay, and dollar CAD. Okay, 57.5 pips down. All right, I also want to have a look at CAD JPY too, because that's always had, well, I mean, that was the strongest currency this morning, so we'll see how big of a reaction we got on here. Phew. Okay, so 58.5 or 58.7 pips towards the upside there on the Canadian dollar against the Japanese yen. So much stronger reaction than before, than the last three meetings that we've seen from the Bank of Canada. Dropping the language for inflation to getting inflation to 2% by the end of 2024 is a key point. And how the bank, and the other point being interesting, that they removed the language of how the bank is prepared to raise rates further if needed. So more or less becoming an open book and not being very clear whether or not, if they are going to, when, basically leaving the book open to say, okay, you're not going to know when they're going to raise rates now. It's going to be more difficult to kind of pinpoint what they're going to do. But what we can do, what hopefully we did today with you guys. Again, as I said, don't forget to share the video and like it, subscribe to it as well. Subscribe to the channel if you found this information useful. That we would have understood that with the rates being raised, there's also the monetary policy statement too that was quite hawkish with it as well, which helped boost the Canadian dollar. All right, so again, FinancialJuice. I keep going back to it now. So FinancialJuice is there to help you understand what's going on in the markets and why that is occurring. And it's also, what it also does, it provides all you need to know in one place, in one feed. So you have your voice news here, okay? You have your voice news here on this button here that I've just clicked. You should see that there. That plays live voice for you in real time telling you or reading out these headlines for you. You can see here, you have the live news feed here for you, the text feed for you, telling you, giving you the headlines again. If there's a headline that's come out and it's shifted sentiment altogether, right? Then again, that's another reason why people use, particularly the big boys, the investment banks. The main reason why there is a use for financial news service is to understand what's going on in the markets, manage your risk in your day trading, okay, and then capitalize on potential risks as well, okay. Humres Fakar says you trade all high sentimental news trade. Yes, so only the big bits of news, that only the big economic releases. So next week we've got CPI and we've got the Fed interest rate decision too. So I'll be covering that in the video, and actually next up on Friday, we'll be looking at the non-farm, the Canadian equivalent of non-farm payrolls of the employment change. But I don't do this every single day. It's only when there is a need to kind of cover a big release, or release that has had a big reaction consistently and is still in the focus of what a trader's focusing on now. That's my thinking there. Hopefully that answers your question there. But yeah, so as I said, what we've got is, so FinancialJuice, again, providing you real-time news of what's going on in the markets and why the markets are moving in a certain way via voice, with your voice feed here, okay, and via text as well. You also have your economic calendar on the left-hand side here. So you have everything you need, and also here you have your need to know market risk of what kind of risk, what other things to be aware of during your trading session, and what's already happened that's caused risk within the market, or what could cause risk within the market during your session. Okay, that's all in one place, everything you need. And again, we've also charted the data as well, how the markets are reacted. So if you do look back, if you do want a quick overview of how maybe the Bank of Canada caused the Canadian dollar to react, if you're not looking at the Canadian currency on your charts, then you can also see that here as well in one place. All right. That's FinancialJuice. So there's also a 7-day free trial of FinancialJuice. Now, what I recommend, first of all, of course, if you don't have a FinancialJuice account, go to the link here on our FinancialJuice homepage, okay, and make an account for yourself. And then also, when you're make an account for yourself, verify your account, have a little play with it. If you've never come across a live voice and text service, then once you kind of feel confident with it, then you can go, then what you can do here is you'll have a button here that says Go Pro. And that will allow you to, of course, experience the news live, no delays, real time, with the ability to, no adverts that play to, no advert banners, okay, and the ability to ask the news desk, i.e. us, the analyst here, working at FinancialJuice, as to what's going on within the markets, or why has the market moved in a certain way, or has there been a certain bit of news, and that's also there as well for you to again, that's the difference between the light version and the pro version of FinancialJuice. But if you do decide to go straight ahead for the pro version of FinancialJuice, make sure you have an account first, verify it, and when you do buy your product or the service that you want from FinancialJuice Pro, then log out and log back in, and they'll act as like a verification, and then you should see the beautiful website that I see here of the FinancialJuice news feed. Okay, that's FinancialJuice, and then so MACROACE as well. So MACROACE, the deviations that I showed you here, okay, with how the markets reacted to the economic release. Again, that's also that's completely free as well to have a look at, which I'll put the link here for you. Completely free. And not only do I provide the deviations for the upcoming economic releases for that week, but I also provide a short summary rundown of what to expect in Europe, the Asia session, and the US session as well, and the summary of the weekend news. Now, just to kind of temper your expectations, it's not a big email filled with lots of data or charts or graphs or charts. See, it's not filled with those sort of things. It's just a short summary of what to expect in the week ahead. Quick little blitz, just like that. And then you have the live stream videos and deviations to look at. And in the live streams is where I go into more detail about the economic releases and sentiment surrounding the economic releases as well. Okay, so again, as said, that is free. I've put the link in the chat for you as well. And then TICKSTRIKE. So if you've never come across TICKSTRIKE before, what it does is it allows you to listen to order flow and be able to see it audibly and visually. Okay, or have it audio and audibly and visibly. Yeesh, this heat. Or another way to put it, it lets you measure how strong the buying or selling momentum is within an asset. Okay, so this number here, you can see here says 1 and is minus figure shows you the selling momentum. The plus symbol shows you the buying momentum. Now the figure here is the slider or the sensitivity that you've set that ticker at. Number 1 is the most sensitive to market reactions, i.e. when there's a little bit of buying or selling that occurs, only then TICKSTRIKE will pop off with an audio and visual alert. Depending on what you want to choose, you can choose either or maybe nothing at all. You just it depends on what kind of suits your trading style. Particularly for your key thing is if you're a day trader, this is another great tool to add to your arsenal. So the number 1, so I said number 1 is the most sensitive to market reactions. You can chop and change that, okay, all the way to level 15, which is the least reactive to market, which has the least sensitivity to market reactions. So only when there's a big amount of buying or selling momentum that's occurring will TICKSTRIKE go off. So again, as I said, you can kind of chop and change it. Like I said, if you're a day trader scalping the markets, then this is the perfect tool to add to your arsenal as well. And there's a 7-day free trial of TICKSTRIKE. Now, if you don't decide to go ahead with the pro version of TICKSTRIKE, that's perfectly fine. There's a free version on the FinancialJuice feed as well. It is limited to 4 different assets. Okay, the S&P, Eurodollar, oil, and Bitcoin. And it also has a set level of sensitivity at, I believe, I'm not sure where it is. I think it's at 6. So it's kind of halfway, which doesn't allow you to kind of chop and change it as you would want to. But still, to kind of get used to how to use TICKSTRIKE, again, it's on the site there. There's like a free version of that already there for you to have a little trial of. Okay, so Canadian employment change Friday morning, 8 a.m. Eastern time. 8 a.m. Eastern time, we'll be going through that economic release together. All right, thank you very much. Don't forget, as said, to like the video, subscribe to the channel, get the word out there, share it with your fellow traders and friends, and I will see you guys then.